Good afternoon, you're watching Bloomberg Quint Live. These are the headlines at 12. Markets slip from opening highs, tepid moves in both benchmark indices. Broader markets trade weak. Tata Motors and Bajaj Auto end 2017 in style. The country's largest commercial vehicle maker sees a 52% rise in overall wholesale sales in December, while Bajaj Auto's sales grew 30%. Salil Parekh takes over as the MD and CEO of Infosys today. India's December manufacturing PMI comes in at a 5-year high of 54.7 compared with 52.6 in the previous month. And now it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, Umesh Mehta of Samco Securities and Senthil Manikandan of Newberry Capital join us on the show. Thank you to both for joining me on the show. Today on Hot Money, we'll discuss stocks like City Union Bank, HDFC Life, Reliance Power, Marathon Nextgen, and since it's a new year, we'll ask them for a stock pick for 2018. Let's move on to the first one, and that is City Union Bank. The stock has been rather active over the past few days. It's gained almost 12% from the recent lows. Today, it's trading rather flat in trade. Valuations of close to 3 times on this year basis on a price to book. Is it expensive? Is it cheap? What should one do with the counter? We'll ask our guest. Senthil, I'll start with you. What do you make of City Union Bank?
So we are neutral to bullish on the stock. If you look at City Union Bank, they got listed in 1998, just 3 years after HDFC Bank. Listing price was around 35 rupees at a face value of 10. So since then, in the last 19 years, if you look at the kind of returns the stock has given, it's around 24%. So
CAGR.
CAGR.
Okay.
So if you look at what has happened, which in giving 24% CAGR is basically over 2 major things. One is the management. The bank has been in operation for the last 110 years, but if you look at the number of CEOs, it has been just 7 CEOs who has been at them for the last 100 years. So there has been a steady management. Second one could be their circle of competence. So in investing, we speak of circle of competence, saying that we should invest in businesses which we understand. So if you look at the bank understands the SME plus trader segment in their core market of Tamil Nadu and South India. So if you look at the other peers like South Indian Bank or Karnataka Bank, or if you look at Federal Bank, so these kind of banks venture into lending to corporate books, which is apart from their circle of competence. So this resulted in higher NPAs, and last 3-4 years they have been increase in provisioning. But City Union Bank was present only in the niche area of traders and SME segment. Okay. So because of that, they maintained their ROEs, maintained their NPAs. So and they are going steadily at around 15% loan growth and PAT growth of 15-17%. So if you look, so from the long-term perspective, like 3 to 5 years time frame, with their circle of competence around the SME sector, we are positive on the stock.
Okay, what's the NPA levels that this bank has compared to the others?
So the bank has one of the lowest net NPAs is around 1.7%. So this is around 30-40% lower compared to its peers. And if you look at their
1.7 or 0.1?
1.7.
1.7.
Compared to peers means the small cap peers, mid cap peers who are focused on the South India based. And if you look at their restructured book is just 6 bips. And they have no S4A or no account of loan coming from the consortium books or something like that. Okay. And they have just one account in the second list of the NCLT. That too they have provided in the as a NPA 3 to 4 years back. Okay.
And valuations are fair according to you?
Yes, if you compare with the other large peers, they are trading at around above 4 times price to book value. The stock trading at around 2.5 times 1 year forward book value looks reasonable.
Okay, so that's the view on City Union Bank from Senthil. Senthil's rather bullish. What do you make of it, Umesh?
I completely agree with Senthil, and to add, City Union Bank is a Rajini of South. Achha. They have really focused into their core domain territory, and they have understood businesses, and then they have invested and lended. So I think that's the real crux, or that's the real moat of this bank, and they don't believe that they can really go out and in order to achieve growth dilute their focus. So I think on an average such solid focused business with decent 15% growth and expected to grow. And this AQR, I think they have really been unscathed. There is a slight nominal impact that they have. And I think it's a overall robust business model, and 3 times current trailing price to book compared to 4.5 times their private sector peers. I think it's fairly valued, apart from slight little bit correction that we can expect from the market. It's worth investing. Then there's a really quality name in the mid-cap space.
So it's more like a portfolio hold stock.
Correct.
So my only thing is valuation-wise, if you're saying it's much cheaper than the private, but the size and scale of the private competitors is also much higher than, because this is one of the smallest private sector banks that you have. So that will also have a big impact.
Correct. So if they are small, they can become bigger. But if all those big guys, how far, so to that extent, but banking penetration.
But it hasn't been able to grow as much as, and that you can ask you also, because you said that it listed at the same time around HDFC Bank. Look at where HDFC has moved, and look, the size has actually widened significantly. So is that not a concern going ahead, that growth probably will not come in as much as a private sector bank should have?
So apart from size, like for a retail investor or as an investing community, HDFC Bank since 1995, if you look at the CAGR of returns the stock has given is around 26%. So City Union Bank has given a 24% CAGR. And this is all with respect to their focus on the southern market. So I don't think size plays a major factor in the future investment returns. So I accept that with a scale comes the benefit of higher returns. But since this bank is focusing on the SME sector, where it's like a moat, like either a HDFC or ICICI or the emerging POs like RBL cannot entrench its market. So there is a clear moat around its niche SME segment.
Okay, and Umesh, any risk that an investor should be wary of for City Union Bank? Any risk that the bank runs?
So obviously general risk that everybody.
General,
but apart from
nothing specific to.
No.
Okay, so it's a general consensus bullish view that's come in on City Union Bank. Senthil is extremely bullish on it, and it's more like a portfolio hold type of stock that Umesh has been speaking about. So it's a consensus thumbs up that comes in from City Union Bank. Of late, let's move on to the next one, and that is HDFC Life Insurance. Of late, a lot of brokerages have started initiating coverages on the life insurance sector. Now, in a very short span of time, we have a couple of listed private life insurers that you have to select on. So is life insurance something that Umesh would put his recommend his client, or HDFC or something else in this sector? What do you make of this sector? And if not HDFC, what else in this sector?
Correct. So when there is a sectoral rush for an IPO, so there is already been fancy and hysteria is already there in that sector, and therefore by definition one should not invest in the sector per se. So we have seen there is a rush of IPOs, SBI Life, and then general insurance companies, ICICI Lombard, so all those coming at the same time. So now let us see valuation, whether it is worthwhile, because yes, growth is there. There is huge untapped potential which India has to capture. So all those secular growth is there. But then what the price that we are paying? The price is huge, 5.5 times embedded value. And you see Chinese companies also have got the same kind of potential and the population, but they are trading at max 2, 1.5 to 2.5. So we are trading at double the valuation, in terms of relative valuation. So if foreigners want to invest, they will invest in India. They say, I'm getting a better deal in China. So that's how. So large amount of fund allocation will not come in this sector at this high valuation. Now, given the sectoral growth, yes, I think 18% growth is possible. Given the growth that we have seen in private banking space, we are also going to see the growth in insurance sector, both life and general insurance. So yes, growth is there, but this is a huge premium. So I think it is better to wait for a correction, let prices cool down, and then. But from an investment point of view, long-term investment point of view, business model is good. So one needs to have this kind of stocks, companies in their portfolio, but save and accept price, So the better, the lower the price, the better ROI for the investors' portfolio.
Okay, so there are a couple of listed companies. There is HDFC Life, there is Max Life, there is ICICI Pru, and there is SBI. So if there is
so the early old listed peers are much better in terms of
so
valuation.
in case if there is a correction that happens, as you point out, which one would be the best play an investor should put his money on? So out of the listed private life insurers.
Correct. So currently,
private and public. Let's include SBI also.
So currently, if one has to invest, then I think ICICI Pru is a safe bet because the valuations are around 40-50% cheaper than the other newly listed companies. But in terms of business model, I think SBI Life and HDFC Standard Life have got a better potential because of their bank assurance branch network, management, and the decent numbers, the track record that they have. I think these two stocks should perform well. But at current valuation, they are overpriced or there is huge premium, and therefore investors will really wait.
Okay.
But if they want to invest, then ICICI Prudential has a better bet because valuations are far better decent than their HDFC.
Okay, what do you make of it, Senthil? HDFC Life, or if you have a view on any other company in this sector as such?
So first to answer is concerns upon the valuations. So if you look at the Western markets, including China, the insurance market adoption follows a S curve. So once the GDP per capita crosses around $3,500, then the growth in the market shoots up. So if you look at the China or the US or UK, they are in the mature stage. So the market has been saturated there. If you compare with India, with a per capita GDP is around $1,800, $1,900. So we are yet to penetrate the high growth stage. So clearly, because of this, I think there is a premium for the insurance players. And second, if you look at the market currently, there is a clear amount of moat because there is new business guys can come and start an insurance company because there is a incubation period of 6 to 7 years. During those 6 to 7 years, the business will be incurring heavy losses. And the existing profit pool plus the future profit pool will be shared by the existing players. So within the existing players, those players who have a strong bank assurance channel will grow above industry. And so if you look at the strong bank assurance channel, there is SBI, ICICI and HDFC is there. So within these three players, we pick HDFC Life Insurance because they have a conservative product mix.
Okay.
Their non-ULIP is around 65-70%. This is second to Max Life. Max Life has a non-ULIP portion of around 80%. So with non-ULIPs around 65%, they are not prone to the volatility in the capital markets.
Okay.
So this is an high yield segment also. Okay. So with the brand equity coming in with HDFC and they are growing at above industry average, valuations seem little bit over premium, but over the 3 to 5 years period, you are positive on the stock.
So it's more like a portfolio stock that you would recommend. And in the insurance space, private or PSUs on the life insurance space, HDFC Life would be your top pick. Okay, so it's a view that's coming in from Senthil. He is extremely bullish on HDFC Life. Umesh, as a story and the business, yes, it's a robust story, but valuations is the concern that he has. He says that wait for a correction that could come in, and his top pick in the insurance space on the life side would be ICICI Pru at this point of time. Let's move on to the next one, and this is probably the stock of the week, probably Reliance Power. The counter is up almost 75% from the lows today. It's facing a downtick, but a massive move that was seen over the past few days. So what exactly is happening? What should one do on Reliance Power? Senthil, any view on Reliance Power?
So the last 2 weeks you're seeing an entire run up in the entire ADGH group. And Reliance Power in particular, we are neutral on the stock since they have 3 operational thermal power units. So all 3 are running at a plant load factor of around 90%. So they are generating cash flows and EBITDA. It's perfectly, and debt to equity at around 1.7. It's we are neutral on the stock because if you see the next 3-5 years, it's going to be a huge growth from the renewables side. And if you look at the major problem currently is the storage problem with respect to the renewables. But if you look at the current cost per kilowatt hour for a battery, it's around $200. But the price has been falling, and the current rate, the price of a per kilowatt battery would be around $100. So with this fall in price of the battery cost, storage will be more favorable in the next 3 to 5 years, and the renewables will be the favor of the power market in next 3 to 5 years.
Okay.
So with this consideration, I think we are remaining neutral on the business and also stock.
Okay, Umesh, were you surprised with the massive move that we've seen in the ADAG stocks and Reliance Power? What do you make of it?
See, this is what we call as a one cigar puff. You know, our power was available at 35, 40, so that had value. But currently at this valuation, so the enterprise value per megawatt, you know, if we buy Reliance Power, we are getting at 8 crore per megawatt, right? Reliance Power. But if we want to set up a plant, it's just 4 crore per megawatt cost, you know, that we can set up the cost. So number one, from valuation perspective, I think the stock is really run up, you know, 100% jump in the profit. Reliance Power currently is 25% trading at 25% premium to its other peers like Adani Power or for that matter JSW Energy. So that's how the huge run up that we have seen in terms of RCom. The entire pack has done a rally. It's hoarding, you know. When everything starts rising, that's called herd mentality. People don't have the sanity to understand what the valuation is. So that's what in short the story of Reliance Power. So now let us understand the business model, you know, whether earnings will sustain, whether growth will come in, you know, whether this becomes a long-term portfolio. The answer is no, because the industries, the bargaining power, the pricing power is zero.
Yes.
Right? Because CERC controls, and they cannot raise the prices, you know, every year based on inflation. So if they don't have pricing power, you know, I think that per se that business model does not make sense, because then the stagnancy will come in.
Okay.
Why stagnancy? Because the next growth is coming from renewable, and these guys are into thermal. And renewable, the energy cost, the per unit cost, every day, you know, in the reverse auctioning system, it's coming down.
Yes.
Third, India is slowly going into a surplus capacity, surplus power capacities. There is a slight deficit, but I think given the capacity that we are running into, slowly by next year we will be into a surplus power state. So then how will that new demand come in? So that's how I think this is a stagnating model. So they have expansion plan in Bangladesh, you know, 750 megawatt gas based power plant. But beyond that, I think things are so when stock market, you know, how do we create wealth? Growth. When there is growth, we create wealth. So we don't think there will be really significant.
So fundamentally,
amount of
nothing
growth.
has changed for this
Nothing
price.
has changed, and in fact, it has now become fair valued. So it is better to avoid or to sell, but not to enter.
Okay, so that's the view that's coming in on Reliance Power. Umesh is indicating that even at this level, it's now trading at a much higher multiple and should be avoided at this point of time. Senthil is neutral on the counter. The next one is another counter which has rallied significantly. Real estate as a space has done well. You know, in the entire in 2017, the entire sector grew by 100%. So in the last 2 days, Marathon Nextgen has moved almost 16%. What exactly is happening? Is it a good bet? Are fundamentals supporting it, Umesh? Marathon Nextgen?
So ideally, from an investment perspective, it's very hard, you know, to bet on a small company wherein there is a lot of variability, cyclicality, depending on the projects. If they get stuck, the profits will be down. So Marathon is in that category. So number one. So currently, I think the best part is that they are a zero debt company, and that's a beauty, and that's a attraction for why someone should go for Marathon at this point in time. But given the management, you know, they are unwilling to share the exact strategy, you know, how they want to take it forward.
Okay.
They are vague projections, and we want to do 15,000 of low cost housing, we want to do this, but that does not give conviction given the run up in the prices, and the risks are now not in favor of investors because there is no margin of safety at current valuations.
So the risk reward is not in favor of the Senthil. You don't track this counter, but any view on any other real estate pick that you would have at this point of time? What do you like in that space?
So if you look at the entire real estate pack, since the demon of last November, they have run up quite heavily. And since RERA coming in, it's going to be positive for the entire organized segment of the sector.
Okay.
And within the space, I think we like the business of Oberoi Realty. Actually, since it has also run up quite heavily in the last 1 year. But if you look at the business of Oberoi Realty, actually they acquire land at a huge chunk, and then they develop residential, hospitality, and then commercial within that chunk of land. And we have seen their steady progress in the last 6-7 years. And currently they are expanding outside of Mumbai into Thane. So Thane, they are planning to develop a affordable housing segment. So we are positive on the entire organized segment, but current valuations, I think we are not favorable.
Okay, so that's the view that's coming in on Marathon Realty as well as the real estate space. Not something that both our guests would look at the current price, because valuations have gone up significantly. And since it's the New Year's, we are asking our guests what they believe could be good potential investment opportunities for 2018. Senthil, you like PC Jewelers. Why?
Yes.
What's the story behind PC Jewelers and what is expected?
So, Indians are very fond of jewelry.
Yes.
So currently the jewelry market in India is around $50 billion. And it is one of the highest growing sectors within India, and it is growing at around 17% CAGR. And if you look at within the jewelry market, since the last 1 year, the organized players have been growing at a rate of 30%. We have seen the growth from Titan also. So within the organized segment, Titan is definitely a leader. So who is the second player is PC Jewelers. So they started into retail segment in around 2005. They have traditionally been an export focused company. If you see the number of retail outlets in 2006, it was just one. So since then they have expanded to around 84 retail stores. So this is across 67 cities, mostly focused in the north.
Okay.
So if you look at the management, since they have experience in export focused, and they have a backward integration of manufacturing facility also. So with backward integration and the steady and without leveraging the balance sheet, they've expanded to be the second largest player in the segment. And if you look at the till now, they have been expanding on their own stores, but now they started with the franchisee model. So currently there are 9 stores in the franchisee model. But going forward, 70% of the expansion is going to come from the franchisee mode. So this is going to be ROE accretive, since they are not going to spend any capital. Just they are going to provide their brand, and then what are the jewelry goods, entire inventory and everything is on the franchisee.
Okay, what's the valuation gap between Titan and PC Jewelers? Because you said they're number 1 and 2. Just
yes.
quick, what's the valuation gap?
So it's PC Jewelers is trading at a 40-50% discount to Titan.
Okay.
So maybe in future, like 3 to 4 years, with the 20% CAGR, we are expecting it.
You expect the gap to narrow?
Yes.
Okay. So Umesh, he says that Indian love jewelry. That's why PC Jewelers. Do Indian love to eat? That is why you are selecting Godrej Agro.
So the larger theme is shift from the unorganized to organized.
Okay.
So Godrej Agrovet is into a category wherein 90% of the players are unorganized, and Godrej is into that category. Godrej has got a strong brand and an FMCG company, growing at 15%, available at 35 PE multiple. I think that's the biggest attraction. All other FMCG companies, well established with brands, are trading at 55-60 PE multiple, and the growth is around 5 to 10%.
Okay.
So the growth is double, but the valuation is half. So that's valuation part. So Godrej Agrovet is into agriculture and so the space that it is operating into. For example, one of the space is aqua feed. So aqua feed, Avanti feed. So you see the multiple valuation that Avanti is trading into. Yes. But the valuation that Godrej Agrovet is into is of a lesser intensity. They are into your agriculture, crop protection. Then dairy, in somewhere in south also they have a dairy product. They are developing that brand. So I think slowly and steadily this mid cap is going to become a large cap FMCG player with steady growth. And the vision of Adi Godrej, he has specifically said that Godrej Agrovet, he wants to become a multi-billion-dollar company with this, and this company in the entire pack is fastest growing company. And given the newly listing and this is to that extent is under research stock, I think this stock should perform well and should give return better than the entire FMCG space.
Okay, so that's the 2018 picks from both of our guests. Umesh is indicating that he sees a lot of potential in Godrej Agrovet, while Senthil is talking about PC Jewelers. He believes that the valuation gap to Titan will narrow over the next few years. Before we wrap up on the show, here's a quick recap of all the guest views on the stocks that we've covered till now. Okay, Senthil and Umesh, thank you so much for joining me on the show. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Stay tuned to Bloomberg Quint.
done, and now how in future it is to be dealt with in India. There is an expert group under the Secretary Department of Economic Affairs which is functioning, whose report is now awaited.
Thank you. Sri Raju Chandrasekhar.
So, since the Finance Minister has clarified that cryptocurrencies are not legal tender, and I'm assuming he also means that it is therefore illegal, would he consider an immediate direction to ban